What's going on, everybody? It's Spencer from Gray Capital. And if you are a multifamily investor, you're an aspiring investor, maybe you're already in the industry, you're an industry insider. Well, I really appreciate you being here with us today because on the Gray Report, we get into everything that's going on in the multifamily industry, real estate, and the economy, trying to bring you the best information to help you make some good decisions when you're thinking about making some investment decisions. So we've got some good stuff to talk today. There's almost way too much to talk about. We're trying to be concise, but we've got macro news with the Federal Reserve. They're meeting today, trying to figure out, are we going to tape? Are we going to raise interest rates? What's going on? We've got new employment data out. We also have some really great reports on the multifamily industry from Apartment List, the National Association of Realtors, and some other sources. Then we also have just on the real estate front, big news from Zillow. So let's just get into it. All right. Once again, we're going to bring in Matt Bosnow. He's the Director of Communications and Marketing here at Gray Capital. Matt, thanks for coming on the Gray Report. Once again, excellent report. Once again, how is your week going and how you feeling?
Pretty good. I'm doing great. I think if I could be so bold,
be bold.
The multifamily market is as warm as our sweaters right now. I think it's getting pretty hot.
Well, it's been a little chilly in the office, so I'm glad that's the case. And I feel like since we've been really doing these, the market continues to be on a tear, and so I feel like we just keep saying things are great. I mean, we're just looking at the data. I feel like we look for contrarian opinions and try to poke holes in things, but man, the data is what the data is, and it is very strong for the multifamily industry, right now, and some really optimistic signs for the future. Not that there aren't a lot of questions out there. Incredibly unique economic times in general.
Yeah.
But
I was telling you, I had a lot of fun gathering some of these reports out. There's some October and third quarter reports, and then looking back at the difference, it's really eye opening. So
yeah. The confidence level, I mean, compared to just before the end of 2020, even things were sort of starting to recover. There was just so much uncertainty still. And if you made some decisions in 2020, bought some assets, you're doing pretty well right now. So just before we get into those reports, Matt, because that's where I want to start on the multifamily front, we've got to let people know just briefly about a new investment opportunity from Gray Capital. It's only open to accredited investors. So if you are an accredited investor, hop on over to graycapitalllc.com/Forest Ridge and take a look at the latest multifamily investment opportunity. Sponsored by Gray Capital. It's at a beautiful property down in Bloomington, Indiana. It's called Forest Ridge. It's 114 units, beautiful asset. We've got a really dynamic value add plan. It's going to be great for investors. It's a great opportunity, buying at a great basis in a great market. So if you're looking to make an allocation to multifamily assets, which we're doing right now, if you want to invest alongside us, hop on over to graycapitalllc.com/Forest Ridge and just start the process while we still have availability, which there is almost no availability left. So if you don't get in, just wait for the next one, but go check it out. Okay, Matt. And again, we got to tell everybody, obviously, to subscribe to the Gray Capital YouTube channel so we get these updates every week. Give this video a like and a comment, again, because we want to know if you agree with us or disagree. Honestly,
you don't have to smash it. I just learned this. You don't have to smash the like button. You can just click it.
I think there's something about the smashing something that gets people excited. I want to know what the YouTube newsletter went out to tell everyone to use the term smashing. But anyway, we digress. Matt, you want to start with this? Let's maybe start with the Berkadia report card. It's not a report. I would say it is not a report. It is a report card, which is
card.
Okay.
But you know what? That's what got me on this tear. And what was useful that they did was they weighed they said, okay, this is what we predicted, and this is what's happening. And you can see on this report card here, they predicted 1% effective rent growth. It's 11%.
Womp, miss.
They predicted occupancy at they predicted 95.2 was their forecast. It's 97.2. And then their absorption, they predicted 320, 212, and the real absorption was 536, 311. That's incredible. And that's another thing. And I'm going to go over this again. I also want to like not necessarily praise them, but like it takes some resources and know-how to make these forecasts in the beginning. It's not like they were way off or
well,
like
who had the data maybe besides our intuition to point to anything other than what they were forecasting. And who's gonna what firm that's trying to maintain credibility is going to stick their neck out and say that rents are going to grow 10% year over year? That's just that because even though that it has happened, or again, market rent growth, even though it has already happened, people still don't believe it. So it's not surprising, and it's definitely not a like, oh, you guys screwed this one up because you can't find any, and you've gone through, Matt, all the forecasts. And so tell us a little bit about that, because you went through a real page, you went through Yardi, you went through all of the forecasts for 2021. And they're all wrong.
And that's what got me started. I was looking at Berkadia's 2021 forecast that they published in January and just kind of reading the opening notes, and compared to the hot market that we're seeing today, their modest forecast, which is, like I said, justifiable because it was issued in the middle of really like the beginning of the recovery, but the middle of the pandemic, really, it seems downright gloomy. And so I looked at these other ones, like, see, well, what was Fannie Mae predicted rent growth at 0 to 0.5. RealPage predicted 0 to 1% rent growth. For Yardi Matrix, I couldn't get a national number, but their best performing market, which was Indianapolis, there was 4.4% rent growth. And then CBRE was at the higher end, but still predicted 6% rent growth by the end of the year, which will probably be more than double by the end of this year anyways. And again, like, I don't hold these predictions up to say, look how wrong they were. It's just incredible how striking this contrast is. And I also think that because real estate investment is such a forward-looking and long-term, it involves some kind of long-term thinking. It's instructive, maybe almost more so than looking month to month, to get these long-term snapshots to really get a sense at the large-scale movement that we've seen this year, that you can kind of get lost in as you gradually move up. From every month. And it's not to say that people haven't noticed 10% rent growth. I think they know it really well. But the character and the quality of these reports is day and night compared to the
Well, I think they're even more important because where in the past it's like, slow and steady, not much change, a little bit of growth, just is there anything kind of big that's happened? But this is so much faster moving, and it leads to what I've experienced is a lot of head scratching, especially older investors, people who've been in the game a long time. They're seeing numbers and figures that they've never seen before in their entire lives, and they see it in disbelief. That's like when I say, rent growth in Fishers, Indiana, or in Zionsville, Indiana, these suburbs are 21% year over year. They just look at me. Because we were looking at going after a deal in Fishers, we were in Zionsville, and we're like, well, yeah, rents are growing 20%, and people, we had some investors look at us like, how are you being so aggressive? And I'm like, well, this isn't speculation. This has already occurred. This has happened. It's continuing to happen, and rents are extremely sticky, especially in this environment with a major supply demand imbalance. So Matt, let's just kind of continue this conversation. Let's look at the apartment list report. I think that makes sense? Continuing the discussion of
and that's
rent growth.
When you started talking about the disbelief, you really see that in the chart that they have in the apartment list. Their line graph really looks like it's going off into the stratosphere, and we've seen this before, in the previous month, but it's still continuing. And just the dotted line of the expected, and it's just soaring above and beyond what you might think it maybe should be.
Matt, do you like these? Matt, do you like these
I don't
graphs?
understand it. I do not understand what it is.
Yeah, and it's like I don't know. I guess it's like what higher rent growth is the red, but yeah, I also and I'm colorblind, so I'm like, okay,
Yeah.
sorry.
No, it's fine. But the line graph, I can get it, and the line graph, you see, what is kind of interesting, and this could be almost a little bit of a relief to me, because when I see these stratospheric increases, I start to think, okay, when is the other shoe going to drop? Well, really, how much is too much, and is it is are we going to be the last one off the ride before things drop again? I think that we're seeing maybe a slight cooling in growth, not a stop or a decline, but I don't think that we will have this unsustained growth. Because if this growth continues, it makes me confused, because I've never seen it before. We're used to this steady thing, and the disbelief of the people that you mentioned earlier. I'm kind of in disbelief too. It's like, how do you plan when every month is unprecedented? It's just hard to make predictions in that environment.
Yeah, I mean, again, going to not here. This is vacancy, just continuing to tick down. But I just want to go to this the month over month growth. Is this month over month?
Mm-hmm.
Sorry. And the month over month is, and sorry, I'm finding it here, but the month over month is.
I think it was that bar graph.
Oh, it was the bar graph. I mean, it's 3%. There's another one. Anyway, yeah, here we go. The month over month, we are in many markets. So this is national. We're growing every month. We're growing at a rate that it would not be uncommon to grow an entire year.
Yeah.
So we're doing decades. We're pushing forward a decade. In multifamily business plans, a 10-year hold period, we may look to achieve a similar rate of growth, maybe slightly more. We're going to achieve that in 1 to 2, maybe 3 years, which is incredible. And I agree. I think the market rent growth, the advertised rent growth that has got, I agree that would have to slow. And if not, then we're dealing with serious inflation. Maybe if wages just go up, and I can see it raising a little bit, but I would assume that it would slow down, just because what comes up must kind of come down to some degree. But what we're going to see, and then this brings us back to a report we're going to look at earlier. And sorry, Matt, I'm jumping ahead, and we'll get to the bulk of it is from this piece by Bill McBride.
Yeah, those are the graphs that I was looking at. You really see, and maybe he tweaked it a little, but it's still it's like,
yeah, well,
takes your breath away.
It takes our breath away. And this is the difference. And we did a video about this. It's the difference between in-place rents and market rents. The BLS, the Bureau of Labor Statistics, they're tracking. They're doing a monthly survey. Okay, what are you paying right now? What's everybody paying in rent right now? Leases signed last year, leases that haven't had their rents increase, but then Apartment List, they're tracking the same metric that a lot of these other groups are tracking, which is tracking market rent growth. And we see the major divergence. First, the divergence occurred, really at the beginning of the pandemic, when we saw rent declines, especially in those major gateway markets, San Francisco's, New York City's. That shows up here of the market rent, where in-place rents still say relatively they're buoyed. They definitely decrease a little bit, but they still they're much less volatile. But then, bam, that line just shoots up as things start to accelerate. At the beginning of 2021, really March is when things just kicked into high gear. And that's incredible. And so we're looking at two different things, but then it's going to take some time for the BLS number, the in-place rents, to match and to creep up to that actual market rate, because leases have to trade over. You're not going to be raising renewals as much typically as new rents. You're trying to maximize your new rents. You're trying to kind of maintain occupancy with your renewals with the gradual bumps. Although I think those renewal rates are going to get up, because I think apartment owners are going to see, I can get $200. I'll suffer the 2 months of occupancy to get the $200 more in rent if I can.
But yeah,
And
that's well, and sorry.
no, go, please.
That's what I think really connects it with the inflation discussion. And I think that's what you may have been getting at
Why not?
is yeah, most people that live in apartments didn't just move in there, and so they're going to see this in the future. And I'm not going to make apartment rent growth predictions, but I will
Why
make
not?
a prediction about the stuff that we're going to hear in the news, and I think that we're going to start hearing a lot about rents getting high and rents raising.
Oh, it's a much more of a common topic now than it was in the past, because
Yeah,
it's a driver of inflation and it's a spiral. And now the wages are increasing also. Wages are going to increase. That's going to increase rents. And again, it's a spiral of, continuing inflation.
yeah,
But maybe before we get into, the Federal Reserve, they're having a meeting trying to figure out, okay, are we going to start tapering on what is 15 billion a month reduction in buying mortgage-backed securities and treasuries? I also heard, Matt, this morning. This isn't in the report just yet, but I know we threw a lot at the wall last night and this morning. I heard that the Treasury Department is going to reduce the volume of treasuries at auction in the coming future. So there's going to be a smaller supply of treasuries being sold for the Federal Reserve or anyone. Less supply means prices go up and yields drop for bonds. And is this it's maybe a different way for the Fed to again create this Goldilocks situation and give them some breathing room of where they can raise rates slightly on the Fed funds rate, but because the supply of treasuries is smaller, rates will remain relatively lower, as the buyers of those bonds will still be buying them and driving the price up and the interest rates down on those bonds, allowing the Fed to say, okay, we'll tick up the Fed funds rate, a couple bips here and there, because maybe if it may affect the short term, duration, it's slightly, but there's still going to be so much demand for so little U.S. Treasuries that it's going to keep rates in check. Along with this, the whole idea of we want to lower rates for longer. We need to create inflation in order to destroy the debt, to create growth, to hit this average, inflation target of a little over 3%, maximize employment. And we think prices will stabilize once all this supply chain nonsense just works its way out, because it's just got to work its way through the system. So I thought that was an interesting,
yeah.
Little tidbit. But everyone is now waiting though. And Matt, I want to know what you think. Everyone's waiting on what the Fed's going to do. What is J-Pow going to do?
And
with
they did
inflation
have
at a 30-year high.
They did have this meeting, and they talked about they mentioned. I think it's more about how open they are and kind of discussing a tapering of their bond buying. But yeah, at their meeting on Wednesday, they are expected to leave interest rates near zero, and they're going to lift its purchases of at least $120 billion worth of bonds each month. Not really too much different than what we've heard reported in the minutes of their meeting in September, but it seems like it's a little bit more openly discussed and a little bit more. It's a larger factor in, I think, people's predictions and expectations of what their actions are going to be. It's hard to see a situation where they wouldn't taper at this point. Maybe they'll keep. Maybe they're doing one thing with the rates and the other thing with the tapering. But on the other hand, I don't think that they've given up their mission of full employment. I don't think that they feel like the economy is where they want it to be in order to raise interest rates.
Yeah.
So yeah.
Okay, so now, Matt, this wasn't on our scheduled discussion, although I sort of did mention it. Just on talk, I'm curious how now I don't know if they have time to really change, because I think that the meeting occurred yesterday. Also happened last night were elections, more importantly in Virginia and New Jersey. The Republican Youngkin seems to have won the Virginia governor's race, which is a big deal. And more importantly, it's a blow to, the congressional Democrats, the progressives, trying to pass this major piece of spending. And they've really lost all their leverage.
Yeah.
Because now, if this race is an indicator, I mean, it's a huge swing because Biden won Virginia with pretty decent margins. Now Republicans are like plus 13 in Virginia. That's a huge swing. The Democrats could lose 40 seats in the House. The next election, they can't get anything passed. They've lost their leverage. They're not going to get as much spending done, if anything, probably something, but not much. Less spending, possibly less inflation, possibly room to not raise interest rates as quickly. Maybe.
This is it's an interesting calculus. It's interesting the way that I'm thinking that electors think, and that a lot of the inflation that we're seeing right now is not because of a bill that's being discussed, but everything that's being discussed is, all the stuff is about spending, about government spending, and 3.5 trillion. Now it's 1.5 trillion, but it hasn't happened yet. The inflation that we're seeing is inflation from policies that were made long before the current discussion. And so I think that there is a strange disconnect, but not an inaccurate one. And I think that people are looking forward, if anything, to this potential Democrat bill, and they're kind of putting the brakes on a little bit. I think that would maybe be the more rational one, but maybe they're conflating it. Maybe they're thinking, okay, Democrats in power, we're seeing inflation, let's get the Democrats out of power. I think that may be the most simplistic.
I think there's definitely more to it than that. But I mean, as I think idiotic, and I'm sorry if I offend anyone, as it is of being like, well, look at the price of gas, and that's like your only barometer of like, well, when under Trump, price of gas was X, under Biden, it's now Y. Like, to me, that's like the dumbest thing I've ever heard, because it's like the president doesn't control the price of gasoline. They're, well, we were drilling oil under Trump and Biden. And that's like not why. That's not what's going on, like, at all. And actually, the last administration, that's once we passed most of the spending that's caused a lot of this inflation. There's other causes. I think giving credit or blame for macroeconomic events to the president of the United States is often just misplaced in general. Not always, but largely. Okay.
But I do think that, if they're going to associate spending and inflation, people tend to associate it with Democrats. If they're going to associate saving and austerity, they associate it with Republicans and conservatives. And that's, apart from any policy.
100%. And, often that is the case. Everyone was spending money last year. That's the thing. It's like, who passed the like $5 trillion? Well, that wasn't that everybody, just about. So everyone seems to be taking blame. Okay. So just on this whole talk, we've talked about stagflation in the past, because it was being brought up starting a couple of weeks ago of, high inflation, high inflation, high unemployment, stagnant economy, prices are rising. Reminiscent of the 1970s, where I think there's pain from back in the 1970s. If you were around in the 1970s, early 80s, to see high rates of inflation, high interest rates, and Barry Ritholtz from Ritholtz Wealth Management, you'll see a lot of his folks on CNBC, et cetera. It really kind of took down this whole argument of stagflation, with really saying, comparing our current economic environment in the times through the 1970s is more exercise of comparing more how they're dissimilar rather than how similar the time periods are. And so I just want to scroll down to these indicators. So in the 1970s, unemployment persistently over 5%, occasionally 9 to 11. In the 2020s, it spiked briefly during the pandemic from 3.5 to 15, and then quickly fell below 5%. A lot of markets we're looking at, we're already at 3%. Inflation averaged around 7.5% for over a decade. 7.5% inflation for over a decade, topping at 14.6% in 1980. In the 2020s, we've averaged around 2%, really less than 2% before the pandemic, and then topping out in 5.4% in 2021. So we've topped out below the average in the 70s. Wages versus inflation consistently fell in real after inflation terms. That was in the 70s. In the 2020s, it rose in real terms after inflation terms, which I want to see the citation for that. I'm curious. Productivity, predated computer internet era, productivity improves were modest at best, and obviously today we're getting so much more productive. I mean, productivity index is way up. If you look at that in general, look how much more we can do. Look at this technology. We're doing this whole presentation YouTube show.
Yeah, that's true.
Pretty easily. Get all this information. We get a lot done remotely. A lot of great technology.
There's
and that's
no
not
one behind the switchboards anymore.
We don't even need somebody. And we're going to be going to the metaverse here in the next couple of years. So who knows what we're going to be manufacturing silicon in the metaverse or something. Maybe we don't need silicon because we're going to just communicate in the metaverse. We don't even need physical things. It's all, I don't understand it. The quits rates that people like leaving their job looking for other stuff. No one was doing that in the 70s. And this is anecdotal, as they say, but it's at or near record highs since data series began in 2001. Business formation low in the 70s, near record highs since 2006. Sentiment from the University of Michigan surveys malaise in the 70s, moderate today. Confidence in institutions high in the 70s, low today. Civil unrest, of course, everything is just crazy. So it is high. So we're not really it's like apples and oranges. So in this whole stagflation term is really just something that's kind of, it's just a term that was coined and made up. It's not like, I mean, they do track it and some economists have put some metrics to define it, but it's not like a steadfast term in economics anyway.
Yeah.
Okay, Matt. We talked multifamily, where the market's going. We've talked about macro. Do you want to talk about Zillow, or are we missing anything before we go to Zillow?
There was only one small thing that I wanted to note other than Zillow. If people have time, I would suggest they look at the Apartment List National Rent Report and look at the markets and how and not just look at each individual, like look for hot markets, but they really have a great map. And I think I've mentioned this before, where you can zoom in on from a major market to you look at their individual constituent markets. And take Indianapolis is really a perfect example of this, where you hover over it and it shows, let's say, year over year, 11% rent growth. And then if you zoom in, you see these suburbs and these submarkets with 19.5% rent growth, 25.3% rent growth, 26, 24, 20, 19. There are, and my point is that everyone, is talking about the Sun Belt, and there are these unbelievably hot markets that are kind of uniformly amazing. But that's also where the competition is. But if you want to look at somewhere that has kind of higher cap rates, so that or lower competition maybe, but also has good rent growth, there are some suburban markets, some Midwestern markets like Indianapolis. I think in Mishawaka, Toledo, Detroit, there are also really good markets there. And that same and it was funny because I was also reading the National Association of Realtors, and they kind of came to the same conclusion. And if you'll suffer me a literary analogy, and this is really why I wanted to do it, because I had my literary analogy all queued up. You can be Ahab looking for your perfect white whale in the Sun Belt, or you can find a dozen deals in places like Akron, Mishawaka, Grand Rapids, or Detroit. There's plenty of places out there that don't have to be the places that people look. There are a dozen deals. The market right now is so uniformly successful that it would be negligent not to look everywhere.
Yeah,
it really rewards this kind of work that's being done.
Really good point, Matt. I think that made sense. Didn't go out too far off the rails with the Moby Dick reference.
Right.
I think it's a really good point, because you can see these markets with incredible rent growth, but the cap rates are in the 2s and 3s right now, or mid 3s, and so you can go to Sandy Springs and outside of Atlanta and get your 25% rent growth, but you're going to pay a 3 cap for it. Conversely, you can go to Knoxville, Tennessee, with 34% rent growth, and you probably pay a four cap. But I'd rather pay a 4 cap with higher rent growth. But then what you were talking about, Matt, which is what we're doing, we're doing right now is we're going to markets like Indianapolis in the suburbs. So like Suncrest, we bought last month. It's right down this road from Speedway, and there's 29% rent growth year over year. So, and we bought that the Suncrest for basically a 5 cap instead of a 3 cap. We're getting similar growth. You go to all these other markets outside of Indianapolis, Carmel 24, Zionsville 26, Noblesville 20, Fishers 14, and actually it's a little bit higher for the Class A and Fishers, just as we know from experience. Why would I pay a 3 cap to get 30% rent growth when I can pay a 4.5 to 5 cap and get 20 to 25% rent growth? I get cash flow. I still get upside, because just that growth is being priced in, and everyone it's the Sun Belt, Texas and Florida, Florida, Phoenix, and all the capital is flowing to those markets, which are great markets, super solid fundamentals. But it's priced in. It's all baked in. It's fully baked. Can you find great opportunities? If you're in the market, you've been in the market, keep doing what you're doing. But for like a group like us, where like we've got our own niche somewhere else, we don't need to go to Phoenix or Atlanta to get some awesome returns. And in fact, I think it's more of the contrarian call of you go to the South, the Southeast, Southwest, we'll go to the Midwest, get some awesome cash flow at the same time, fly a little bit under the radar, before everybody else finds out about it.
Yeah, it's true.
Just what we're doing.
Human work.
Yeah. It's a little bit more work. It's a little bit more work. It's easier to tell a story, and it's less thinking to be like Sunbelt migration. Okay. Makes sense. Atlanta, big population. Let's go there. Texas,
hey, what
Florida.
if we made an AI that could buy homes? I think you mentioned that.
Somebody did that. And somebody did that. Let's see how well that worked out. Thank you, Matt, for the great transition. It takes a little bit of a human touch, I think, not just a computer. And, when you have a super efficient market like the stock market and equities, I think, you can probably get an algorithm to do some work for you. Get your bots working. Apparently does not work as well in terms of illiquid assets like real estate when you let a computer make a lot of your decisions. Zillow, totally screwing the pooch. So they had some kind of AI algorithm that was buying up homes, trying to flip them, and it was an incredible disaster. They've lost all kinds of money. They're have to cut 25% of their workforce. They have to sell 7,000 homes. They were buying houses and the next day putting on the market for a loss. None of it made any sense. And what is the most fascinating part of all of this is that this all occurred in one of the best markets for housing of all time. So
if you could pick a beginning and an end date. Yeah.
How did they lose money during this period? It's incredible. It shows that why we like the real estate market is because you have to, there's not all the data points. We try to find as many data points as we can, but there's not a lot. You don't know everything, and you can have a little bit more information than maybe the AI knows, and you can make some get some nice wedge deals. And I think it's going to ensure caution for kind of the next group that tries to automate this in the real estate market. Again, can it be done? Well, anything's possible, but Zillow screwed this one up.
Yeah, it is interesting. And I said, the real human work. I think I don't want to overstate, in real estate is, because a relationship business. But I think one of the most important aspects is, like you said, it's illiquid. You're not getting that price generating, that the data isn't getting updated as fast of a rate.
Exactly. Yeah.
And instead, you're kind of relying on other forms of information that maybe computers can't capture right now. Maybe they find some way of getting that fuzzy middle ground and being able to kind of quantify it. But at this point, at least in the example of Zillow, it's not there yet.
Yeah, that there's the data isn't, the frequency isn't high enough. There's not enough volume of data. And they're probably taking what they had and extrapolating. So I know they've got good data scientists. They have good data, but maybe it's not just having the data. It's what you use, what you do with it, how you interpret it. Yeah. And, the garbage in, garbage out. Who knows, the actual quality, although I assumed it'd be pretty good seeing so much volume of real estate trading through Zillow. All right, Matt. We covered a lot.
That was a good one. It was a good one this week.
Yeah, I think so. If you'd like to stay up to date, kind of in between Gray Report recordings, such as the one you are continuing to watch, there's one place to go, and that's grayreport.com, www.grayreport.com. It's the premier multifamily intelligence aggregator. This is built by Gray Capital. It's got Matt's hands all over it. And again, we've got a lot of the same stuff you see on the report, but just more of it, keeping you up to date. Latest videos, podcasts, research reports, articles. If you look what's up at the top here, you want to learn more about Gray Capital's latest multifamily opportunity. There's a link to that video, and we just encourage you to check it out and tell us what you think. Again, if you enjoyed this video or you did not enjoy the video, let us know if you did or did not below in the comments. Have any questions, any topics you'd like for us to cover in the future? We would definitely do that. We would be like, yes, we have to serve the audience. I'm excited for that opportunity because no one's done that yet. So be the first. Definitely get a shout out on the show. But if you're going to do that, you probably have liked the video, given a subscription, the trifecta. That helps us. It gives us encouragement to all right, we're going to keep doing this because people are actually watching it. That's why we've continued the newsletter, because we've gotten so much positive feedback, people telling us that, and if you haven't signed for the newsletter, obviously graycapitalllc.com/newsletter. People said, how much they appreciate the newsletter. It's such a useful tool, how they look forward to it. And that's why we started doing these recordings. Like, let's recap. Let's give people a video element, another way to consume the content. And we're getting good views. We're getting more subscriptions. But the more feedback, let us know. Okay, it's worth taking some time to prepare these shows, do them, get them edited, recorded. It costs time and money to do. Also, Gray Report. Check it out. Let us know what you think about the Gray Report. Any changes, improvements. I think we could take the Gray Report to many different levels. I've got a bunch of crazy ideas that aren't necessarily the top of the priority list, but it could be a lot of fun. We've talked about chat rooms in the past, Matt. Maybe a message, maybe a guest book. But I think I think would be cool is to have some kind of listing service for syndicated investment opportunities that like isn't curated. It's just you can just post your stuff. It can be like Napster. It's like you just post it.
Yeah. You can't download a car, but you can download.
And you're not stealing other people's reports, obviously. So maybe that's not okay. It's like a Craigslist. How about that?
Yeah, I like it.
Is Craigslist? People are on Facebook Marketplace anyway. Post your deal. We wouldn't be endorsing it, but you can post, if it's a 506c deal, you can post it. It's not going to be endorsed by us, but it's buyer beware, obviously. But, open marketplace. Because we know so many investors who are just, I want to invest in a deal. I just can't find the deals. And maybe we'll put like a little inventory or directory of, syndicators that do 506b. You say, Spencer, why would Gray Capital do this? Why would you help the competition market their deals? That's a great question. Rising tide type situation. We've got more investors than deals right now. So if we can push the industry one way or the other and make it a better place, more transparency, we're all for that. So let us know if that sounds like a good idea to you. And we appreciate it. All right. Thanks for watching this great episode of the Gray Report. Again, do all the things we told you to subscribe, do all the stuff. Got some homework. Okay, Matt, thanks again. Have a good one. See you next week.